morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. If I could sum up the past week, it would be one of markets saying US inflation has peaked. At least that's what it seems from a reactionary point of view. We saw the dollar index hitting new low for this year while euro and pound hit new highs. This was on the back of weak economic data coming in from Europe. Let's hear from JK the latest in the financial markets. And right before you start, I have a question for you. Given the weak economic data coming in from Europe, wouldn't a strong currency pose challenges, especially for the export sector of the EU? How do you see that narrative?
Good morning, Swaraj. It's a good question. If you look at the policymakers' approach in Europe, they have been actually hiking into weakening economy. We have had a series of weak economic data from Europe in the last 1 to 2 months. And in fact, both Germany and the euro area have slipped into a technical recession. But they have maintained inflation as their primary goal, so they are still hiking. Now, if you come to the currency part, again, a strong currency helps tighten. And it's an indirect monetary tightening. Therefore, you will see, imported prices falling and inflation coming down. So currently, that is the basis on which they are following. They are actually following a policy of benign neglect on the currency and very keen on taking the interest rates higher to reach their inflation goal. So that I hope that answers your question. Now, the sharp run-up in financial markets in the last 10 days seems to have passed on the Friday as they reached strong resistances along with the fresh bullish news on the US economy. Michigan consumer sentiment came at 72.6 versus 64.4 expected, and even more surprising was the rise in 1 year forward inflation expectations from 3.3 to 3.4, while the 5-year forward inflation expectation remained unchanged. Now the surprising thing is the sentiment came up because of fall in inflation, but the inflation expectation in the survey itself was higher for 1 year forward. Now, the biggest impact of consumer sentiment and inflation expectation was felt in the bond market, where 2-year jumped from 4.6 on the previous day to 4.77, 10-year from 3.75 to 3.83. Of course, looking at the big fall seen from 5.12 and 4.09 respectively for these tenors before the inflation data, this is only a modest retracement. And the market would like to see more data on the economy scheduled this week, Empire State Manufacturing Index and retail sales. Fed member statements will also be closely watched, almost as we close in on another meeting of the FOMC. Probability of a 0.25% hike in July is up at 96.7%, while expectation of a rise by 0.25 in September has slightly risen to 13.5% after Friday's data. The US Treasury curve has bear flattened on Friday, following better than expected data. Reaction to the uptick, has triggered also a scale back in Fed rate cut expectations over 2024, also fueling a jump in the, apart from fueling a jump in the yields. Now, for instance, looking at the OIS market, rates in June 24 now prices 4.68% from a peak of 5.4% in November, this year, and 14 BPs higher related to what was expected, just on Thursday. Now, on the equities, they had a mixed day with only Dow gaining about 128 points. That was again helped by strong reports from JP Morgan, Wells Fargo, and Citigroup. A good earnings report. Also, the P banks have been raising forecasts for the net interest income, because the high interest rate policy by the Fed has actually helped these banks increase their net interest income. And of course, there is also a statement by them that they are providing much more for a possible defaults on the mortgage loans. Now, coming back to the dollar, after falling for 5 days in a row, USD found some support on Friday with the move up in USD yields, but nothing significant actually, because they are still quite close to the highs seen recently. And cautiousness in equity markets has, of course, helped the greenback. DXY gained 0.14%. And from a technical perspective, close below 100 mark on, has made the index vulnerable for further declines. This is close below 100 mark on a weekly basis, and softer US CPI data out halfway through last week has fueled the notion that Fed is close to ending its tightening cycle. Much of the other fall came against the cyclical data, which clearly favored US and was quite negative for Europe. Now, in my view, the dollar is moving with flows and perhaps scaling back of some of the structural shorts the investors are carrying, rather than looking at the cyclical data from from the various countries. Now, China still struggling. News over the weekend was not helpful because home prices were falling for the first time in 5 months, and yet another piece of economy slowing is the retail sales came lower than expected this month. GDP also, GDP came lower than expected for the quarter 2, and although retail sales and industrial production data were steadier. The USD CNH, the offshore yuan, has once again jumped to 7.17 after hitting a corrective move of 7.12 last week. On the rupee, once again, actually the downside is becoming quite solid with bids from PSU banks, and once again this is again a demonstration of currencies not really reflecting the fundamentals because we have seen good buying despite all the factors, including the asset markets and the macroeconomic picture looking good for India, inflation falling and growth also improving. Of course, we did have deflationary data of wholesale price index on Friday, which was fell more than 4%, the factory gate prices. But again, that's not much on the radar for the central bank's policy, because they look at more at CPI, and wholesale price does not include the services inflation. There's also some concern on the trade numbers, because after falling sharply month on month to near 16 billion for 3 months after January, we are once again seeing the numbers inching up to 20 billion plus per month, and a small decrease in the net services exports is also observed. But the important point to note is that both exports and imports have fallen in and around 20% on a year-on-year basis, and this is in keeping with the trend of the global economy, where global trade itself has been falling, and this is because of the slowdown in China and Europe. And I mean, further slippage in exports may cause some more concern among the policymakers here, because that is one sector which is employment intensive. Possibly one reason why even the rupee is being held on a very stable range. Don't expect much to happen in the rupee until we see any large flows hitting at the lower levels, then which may force RBI to abandon their buying support. Otherwise, if dollar index does correct by 0.5 to 1%, which I expect in a very slow and grinding way, we might have even uptick towards 80 to 50 or 60 on the USD INR. Thank you.
Thank you, JK. And some key data points which were released on Friday was, of course, the Michigan consumer sentiment from the US, which came higher than expected, while one-year inflation expectations also came higher than expected, leading to a jump in the US yields. US retail sales and manufacturing index is something which is coming, data which is something coming due this week. So let's see how that impacts the market. Of course, the softer CPI data last week has created the narrative that Fed is done with the tightening. On the other hand, China is still struggling. GDP came lower than expected. However, retail sales was still steady. For rupee, downside support is looking strong. WPI showed a deflationary picture, but the RBI will be focusing more on the CPI data. That's it from us today. Thanks for tuning in, and look forward to catching up with you tomorrow with another round of fresh updates. Thank you so much for listening.